Welcome to the Turnaround Podcast with your host, Stephen Phillips. In each episode, Stephen speaks to experienced practitioners who discuss their careers, key moments, challenges, and lessons learned in financial turnarounds and business restructuring. Join us as we unravel the secrets to turning struggling businesses into success stories. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, frylibertas.com. Now, here's the host of the Turnaround Podcast, Stephen Phillips.
It is my great pleasure to introduce Andrew Pepper, a partner and head of Special Situations and Restructuring at the newly relaunched professional service firm S&W, a top 10 accountancy and advisory firm. Andrew was previously a partner at the independent restructuring firm Resolve, which was acquired by Evelyn Partners in October 2024. Evelyn Partners recently sold its professional service business to funds advised by Apex Partners. The sale has just completed, and this professional services business will trade as S&W, building on the heritage of Smith and Williamson, which was originally established in 1881. Andrew has been a fixture on the turnaround scene for many years, having fulfilled many roles including CRO, non-executive director, chairman, investor, and advisor. Andrew has over 3 decades of experience in high-level restructuring and turnaround roles, including within the partnership of BDO, Kroll, Zolfo Cooper, and Hilco Capital as COO. Andrew is the recent past president of the Turnaround Management Association, and he is a qualified chartered accountant and holds an insolvency practitioner license. Andrew, welcome to the show.
Wow, what an intro! Thank you very much. How much do I owe you?
Well, nothing. I like to big up my guests, and quite rightly too. You've got a lot of experience. We've got a lot to get through, and I always start with prior experience and careers. So to kick things off, Andrew, can you just give us an overview of your career so far?
So I started off as a mainstream sort of person doing restructuring. So for many years I was at KPMG, and then I made it to PwC as a departmental senior manager in the days when there was only one senior manager in a department. And then I made BDO partner in 2000 when I was about 30, and then went on to do Kroll, Zolfo Cooper. The thing is, I was a bit there. I was an advisor. I was an insolvency practitioner. I did the usual standard old-fashioned stuff where basically I was the administrator of large businesses, small businesses. I just got on with my life and really, really enjoyed it. And then one day I woke up and thought, I really want to be an advisor as well, but actually advising with my own money. I wanted to take that commercial risk. I wanted to be an owner. So I went and joined a business called Hilco Capital and helped develop that with a friend. And ultimately, I owned a percentage, my friend owned a percentage, and the money had a percentage. And it was one of the very first few distressed investment capital raising businesses. And I did that for about 9 years. Retired out of that business, went around the world, took some time off, and then got bored, to be honest, because what drove you to do what you wanted at the age of 30 is that you just can't get it out of your DNA. So I started helping out smaller businesses. And then every year I got involved in some large businesses. So I was brought in by Barings and M&G to help on House of Fraser. I was lined up to help them there. I helped on a few mines. I did a lot of other processing work. And then one day a friend of mine came along to me and said, Andrew, we'd really like to set up some turnaround business. This was at Resolve. And ultimately the Resolve business was brilliant at administrations, liquidations, more of the traditional stuff. But they really wanted to create a bigger bag, a bigger toolkit. So I came in to assist them to grow that. And then over the last couple of years, we've won a few awards. So we won Best Turnaround Award from Standing Start. We actually came in the top finalists for Best Turnaround Team. And then we also applied for a Best Turnaround International. So we went from very little to a very lot in very quick succession. And then ultimately, Resolve was then purchased, as you said, by Evelyn. And then Evelyn then sold us to S&W. So that's the quick, very potted history. It's a case of being the advisor then an owner, manager, a director, a chairman, an investor, and then back to being advisory again. And that's why I think sometimes I have kind of a unique set of skills, because I've got complete empathy with owners and advisors.
Got it. And if you were to meet somebody in a lift, just a stranger, how would you describe what you do?
It's a bit trite, but I think I'm a problem solver. I'm a solution giver. My aim is to say, if my competitors or the average person can deliver 3 or 4 ideas, can I, using my experience, my history, deliver 7 ideas? Now, sometimes those extra ideas won't be brilliant, but on average, if I can generate 3 or 4 different extra ways of thinking outside the box to give a solution, then ultimately I should win and help my client. So for me, it's all about problem solving. When I try and take it back to basics, it's like a company doctor. Sometimes I have to chop a foot off to save the body. So sometimes that's quite a very visual depiction of what we do. But again, it's trying to give advice and show alternative ideas and alternative ways of looking at something. Not it's a straight administration, it's a straight liquidation. Think outside the box. Can we keep this going and open up the business to other things? So when I describe myself to people, it's a very much holistic approach.
Got it. And I mean, I know you're no longer involved with Hilco, but I think it's such that there have been so many really interesting case studies it was involved in. Can you just give me a sort of a smattering of examples of situations you were involved in, how they developed at Hilco, and what the end result was?
Hilco was a wonderful time. Hilco was one of the early distressed VCs that went out there and saw value in things that perhaps traditional lenders saw no value. So what we'd try and do is work out, say a bank valued a business at 5 million, and we thought it was worth 8. We would bid slightly more than the 5 million, take control, and often try and turn around the business. But sometimes we failed, and sometimes we had to liquidate it, close it down, or close half of it and sell half of it. So a great example would be Habitat. We bought Habitat from its original owners. It was suffering in the UK and in Europe. And within 18 months, we'd reduced the loss. I think it was losing 30 million a year down to a much, much lower loss. And in Europe, we managed to sell the complete European business as a solvent deal, and it's still around now. In the UK, we run up against issues around the leases, because the leases were set out in a certain way, which meant we couldn't really negotiate with the landlords. So eventually that went into administration, but then the business was sold to a third party afterwards. So big success. HMV was another great success. We bought it out of a failure, and ultimately many years later we sold it to Sunrise Records and Doug Putman, who basically still got it now. So therefore redefining what it was. Before, it was always a music business. Then we started putting in vinyl and other alternative things, and then Doug has taken it on. So the idea that we go from a failure, in what somebody's eyes it was a complete failure, to now it's still a nice business making money. That to me is a real testament to what we did. We saved the business, reimagined it, and then we sold it to someone else who then reimagined it again. So that's a beautiful way of looking at things.
Yeah. And I guess we've talked about the fact that you've had lots of different roles: insolvency practitioner, owner, entrepreneur, director, advisor. Which do you enjoy most, or actually is that the wrong way of suggesting it? That perhaps what you do enjoy is the thing you're doing at the time.
I think it's the attributes are what I enjoy. So the attributes of providing a solution, whether you're a chairman, an investor, or an advisor, your aim is to provide a solution. So I think gone are the days for me, I want to be an advisor, I want to be a chairman, I want to be a specific thing. I want to do a specific thing. I want to have the holistic idea. And I think what's enjoyable is bringing all that history to bear on the current situations and say, how can I help my client? Because I've done something similar to that 10 years ago, 15 years ago, or even a year ago. And that to me is the most important thing. It's actually fun as well. Sometimes looking at one style of business and saying a very obviously different business had similar attributes. So I spend a lot of time deconstructing businesses. So therefore, you might say, what's the difference between a retailer and a recruitment business? What I try and do is take it down from retailer recruitment down to the key attributes. And what you might see is patterns. I often talking patterns and selling patterns and communicate, wave my arms around and try and show people how things can be done in a very entrepreneurial way, but also a very descriptive way. Sometimes I think accountants are guilty of just talking in numbers. And my key issue is that if I talk in numbers, but the shareholder or the director only receives in visuals, we're never going to be able to connect. So you've got to work out who is your client, how does he interpret information? And as an owner or an advisor, how do I talk in a way that I know that my knowledge will get through to him? And he'll go, great, I understand it. Because so many times we talk to people in a way that we think we're broadcasting brilliance, they're receiving confusion. So to me, that translating issue is so vital.
Well, let's move to talk about what you're doing now. We've talked a bit about the past. So S&W just recently relaunched. What's your unique selling point? What are you trying to achieve at S&W?
S&W is a great little business. It's not little, it's 120 partners. I think we've got 1,800 staff. We've got 24,000 clients. We've got a very long history and heritage because it's been going for over 100 years. So we can bring all that to bear on my, department. One of the great things about S&W for me is the fact that I've got 120 partners who are now talking about sometimes special situations, talking about success. So when I was at Resolve or when I was running my own family office, it was one or two people doing it. Now we're in a bigger organization, a very commercial organization, a mid-market organization. That allows us to go to the market and say, we talk your language. It also has the ability to allow us to be partner-led. And I think that's a very strong point. Some of the larger competitors perhaps aren't as partner-led as they once were because the nature of the pyramid of fees and the pyramid of structure. Whereas in special situations, I think you have to be partner-led. Someone has to believe that whether I'm S&W or something else, I will help them, I will hold their hand, and I will get them through a problem. And sometimes the brand is very important, but I still believe the individual is more important. So someone buying into S&W is buying into a mid-market team of people who've often worked in industry, have come back, and therefore show real empathy to our clients. That to me is the most important thing.
Got it. And I think when we were discussing this before, in our preparation, you were you're very clear that what you're trying to do is perhaps meet a company, get to know a company, get involved probably earlier than many of the traditional insolvency practitioners would do. So maybe you could talk a little bit about your strategy and how you think that you can help people.
So there is a thing in my industry, which is a cycle of decline. So you'd have corporate finance work here, liquidation here, and there's a cycle of decline. So if you're a straight insolvency practitioner working in the liquidation and administration area, you're down here. And if you're corporate finance, raising money, being positive, vanilla, you're up here. I work at the higher levels. The thing is that I don't want to necessarily see a company that's going to fail tomorrow because I've got no chance of really helping them. My colleagues can, and of course I can help as an insolvency practitioner, but in special situations, what I want to do is save the business. And we've had many outturns where I've saved the business solvently, not just saved the business through a pre-pack. Some of my competitors will say, oh, I saved a business today. And basically I put it through an administration, creditors lost money, shareholders lost money, but I kept the employees whole. Now that's great, but that's not necessarily saving the company. What we try and do is do some form of solvent deal where there may be haircuts, but where ultimately the business is falling and then comes back and turns around. To do that, you need some time. You cannot come to me 1 week before the payroll and say, we need to raise £5 million and basically, can you undo the whole of the system? So what I try and do is do a thing called a cash runway. If I can stop people forcing the business into a problem, if I can do stakeholder management, I can keep people at bay and I can help the directors, all the shareholders, all the VC, all the P house, find a solution. Sometimes I can't find the solution on my own. I need them, but they need my skill sets to basically push creditors away, construct a deal frame that allows the creditors to say, I'm being pushed away, but to a greater good. Because ultimately, Andrew's keeping in contact with me. He sends me a letter every week. He tells me what's going on. Just going, no, 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 go away, doesn't cut it. You have to have communication. People have to believe that being pushed back is part of a process to deliver a positive solution. And if they believe you, they go, we'll stand back a while. So I've done that on many cases where ultimately you can build out 6, 9, 12 months worth of space. But then you've got to do something with that space. So many directors out there will go, great, Andrew, you saved me. And then we'll go quiet on you. And then they'll come back in 3 months' time saying, things haven't really changed, but now we've lost 3 months and there's only so much time you can regain. So again, it's very, very important.
So I presume that one of the frameworks you must be looking at is putting new money into a business if it's beginning to fail. Presumably S&W doesn't have that money. What you do have presumably is a pocket full of contacts and people that you can sort of call up. Is that one of the sort of selling points for going to you?
So there's 2 selling points. One selling point is the fact that you're going to get great advice from people like us who've been around the block and are very practical. Therefore, we can create energy, we can create logical advice, and we can help the client. Second is that we've got a very large commercial black book. We've got a number of people who will put money into businesses. So every week we are basically talking to those people saying, we have a new client. It requires 5 million, 10 million, 20 million. These are the attributes of the client. So we create a teaser that goes out. That will often go out to 300 to 500 people, dependent on what style of proposition we've got. Sometimes it's a straight lend. Sometimes it's a loan plus equity. And sometimes it's everything, because ultimately the case needs everything. It needs the kitchen sink, to be honest. So we look at it that way. And therefore, we're very successful at going out and actually showing our black book of clients, this is a really good idea. It's a business based in X, it's doing Y. And then we translate all the difficulties into bite-sized chunks to say, this business needs 5 million because of 5 good reasons. It's lost money in the past for these reasons. It will not lose money in the future because we've stopped those reasons. So you have to sell a story, but it can't be a Jack and Nori story from years ago. It's got to be a factual story that says, why is this worth a bet? So when I've looked at things in the past as Hilco, we'd often get things put on our desk, which is, this business has a problem, it needs X million pounds. The best ones were ones saying it needs X million pounds to do A, B, and C. We've got, as an IP, we've gone over it, reviewed it, and therefore we can recommend it. So therefore what we try and do is give recommendations. We try and put the client in front of the most appropriate investor or lender. And then we kind of, like a Venn diagram, we try and bring the two together to say it's a risk, because ultimately, if it's vanilla, you wouldn't be here, but it's an acceptable risk. It's a quantifiable risk. And that's the important thing.
I think one of the things that I mean, obviously I get similar kind of approaches and I don't purport to do, anything like what you do, but, I do get people saying, I've got this problem, do you know anyone? One of the issues, it seems to me, is that most of the people who want to provide money, the funds, they want to provide 20, 30, 40, 50 million. And often, if you're in the mid-market space, 50 million isn't what's needed. It's 5 million or 3 million or 8 million or 15 million, perhaps tops, maybe 20. Do you have do you think that capital need is something that you can find? Are there a lot of people who want to do this?
So we try and stratify our black book into smallish lens, 1 to 5, 5 to 15, and 15 above. So therefore, we sometimes struggle with the smallest. It's interesting. Sometimes we struggle on certain days with the smallest loans, and sometimes we struggle with the biggest loans. I think the problem is that you can always make excuses. But the biggest thing is if the deal isn't good enough. My view is that if you have a good deal set out in a good way and explained in a straight and practical way, it'll find money. The problem we've got is sometimes the deals are so too far gone, or there isn't a structure to the business. So, for example, the business might have had 35 million invested in it. It's a tech business, but it's had to pivot twice. It hasn't got annualized revenue. Its customer base isn't quite convinced. And therefore, it's nothing about the money. It's about, unfortunately, the core business not being fit for purpose. And maybe 5 years ago, it was a cool business, but today it's not. So therefore, I think there are lots of people out there who say, I'm always finding problems trying to find the money. But to me, it's not finding the money is the problem. It's generating sufficient quality in the output of the company. How do we translate the mess into something that's capable of being invested in? That to me is a key talent.
And I think that's a brilliant insight, because I think often if it gets onto my desk, it is invariably a mess. And actually creating a kind of a booklet that explains the problem, that explains the need, explains the sort of operational changes. That's actually a very meaty piece of work. So I do understand why you're saying you need to call me like a year before the crunch point, because otherwise it gets on a desk of somebody like me in it, or or even you, I'm sure, where it's just too late. So early is the better, and I suspect that your skill set has got to be about seeing the mess, but actually seeing, how the phoenix can, rise from the ashes, and presenting it to people who are very busy. I think that's one of the key issues, that it's so often, many of our clients might have 50, 100 things shown to them in a month. And unless you're, pretty good at presenting and you've got a good story, it's going to be difficult to get their attention.
I think it's that idea of you don't need a year, but at the same time, if it's a straight vanilla deal, it won't be on my desk and it won't be appropriate for the investors. So I often talk to investors and say, what do you ideally require? And they'll say, underperforming business that's lost its way. The bank doesn't like it too much. The PE's lost its way. They've spent millions of pounds on it. It's maybe over-invested. There's a big asset base. Maybe the director's lost his way. And the trouble is, what they're boiling it down to, they want to buy a pound coin for 50 pence. So, of course, everyone wants to do that. So I sometimes roll my eyes and go, oh, gosh, why are you saying you want something which is unobtainable? But however, you need to have problems with it. Otherwise, there's not enough upside for a special situations investor to deal with. Because ultimately, if his money or their money is at 8% to 10%, that's fairly mainstream lender money, and therefore that implies the lender doesn't do any work. For special situations to get involved, they need something in the mid-teens. They need an equity sweetener. They need some form of positive extra, because not only are they lending money or investing money, they're invariably sending their team in to assist. And if your team member is got a job for £100,000 and the cost of the heavy lifting is actually very expensive. So unless there is a real upside to the investor, why would he bother? He'd just put the money into 8%, 10% second charge money on a boring property where there's no need for brain power other than, is it valued at X, and do you basically collect the rent? So we do actively want problems. Now, the problems shouldn't be insurmountable, but if there's no problem, then there'll be no special situations people.
Got it. And are you, would you sort of say there are just certain sectors or certain areas that are just in the too difficult box? I'm sort of thinking particularly a lot of things that come on my desk are sort of tech companies. and that always seems a very kind of binary thing where, they probably don't have a factory, they don't have fixed assets, like everything's in the IP, and either the IP is sort of something that people love, or they haven't yet, or it hasn't quite worked. Are you more into a sort of heavy assets, or do you think that actually pretty much any sector can be rescued?
Well, as a practice, we're sector agnostic. However, we've got some very strong areas such as property, retail, and tech. Now, the issue with tech is that when it's working brilliantly, it doesn't want any assets, because the assets are invariably people, the IP, and therefore you don't have a factory, you don't have big infrastructure, because you're putting all your money into the brains. The trouble is, when tech goes wrong, the underlying assets are the people. And if you don't pay them, or they don't perform, or maybe you have to pivot 3 times, or the product isn't very good, or the customers don't quite get it, at that point, it can be quite binary. It may not be worth anything. So I've done quite a few tech businesses where they've had 20 to 35 million spent on them to do something, but the product doesn't work. And so you say, oh, if only I could find 5 or 10 million pounds further, I could get it to work. So what's the price of a product that doesn't work and is 10 million away from working? The price could be 0, it could be £1. So even though someone has invested 35 million into the business, it's a very hard pricing to call. So what you can do is try and get a valuation, and there's many valuers out there who will try and value IP, but IP is often a future rolled back, a DCF calculation of future income. If you're not making any money, it's very difficult to show the DCF calculation. So what you have to show is competitive tension. So if we can show that tech to 20 people who we know are interested, either as a bolt-on or as a trade purchase or as a finance deal, we can at least get the price to come up, because in the absence of commercial tension, the value could be £1, which is absolutely horrendous. It's 35 million to make £1. Whereas manufacturing, you always know that there is a factory, there is a building, there is plant and machinery, there's book debts, there's hard assets. So when it goes up and then it comes down, there's always a base level of money which the lenders have lent against and then can secure. That's why often you don't get normal bank lending in the tech world, because there's nothing really much to lend to. Whereas in manufacturing or in recruitment or asset-based lending style businesses, there's a heavy element of solid asset.
Got it. Yeah, no, I see that dynamic a lot. And I think one of the things that any tech founder should be really wary of, and I've seen the dynamic where they may well have some very solid venture capital names, in their shareholder register, and it all looks good, and they're coming to another round of financing. And often, sometimes the venture capital guys just go, I've looked at the business, it's not for us anymore. It's not quite succeeding in the way we thought. It's just not as big as we thought, etc. And you go from a situation where you thought that you're about to raise a certain amount of money to crisis point within a very short period of time. And I don't know if you've seen that dynamic, but I would almost sort of think that maybe sometimes, even if you think that your venture capital backing is good, that having somebody like you in the background, on occasions where you're not 100% sure, might be a good alternative to just.
In the past, outside of my insolvency restructuring work, I've often been brought in to be like a chairman. Now, the reason why you think, why would an insolvency practitioner be brought in to run a company? It's because when you're dealing with restructuring insolvency, every day matters. If you are losing £10,000 a day, you have to do stuff. If you're in a wonderful business that's making £10,000 a day, you should still do stuff, but it doesn't have a downside to it. If you delay by 5 days, oh dear, I've made £50,000 extra. Oh dear, I've delayed by 5 days, I've lost 50,000. It concentrates the mind. So actually having people like myself and my kind of colleagues in the profession are actually quite useful to have on boards as either chairman, observers, NEDs, advisors, because we get things done. We see things with an eye to urgency, but not like we have to sell everything for nothing, no price, or we have to do things in a very too rigorous a way. But sometimes I've gone into large companies or even small companies, and you sit and listen at the boardroom, and it's quite painfully slow. And you're thinking, guys, this is a wonderful business, or it's a business that's not performing in the way it should. It still makes 2 million, but it should make 5 million. How can we move it from 2 to 5? So therefore, that driven approach is just as important as when we talk about special situations where they're losing money. So again, myself and my colleagues often get involved in businesses that are performing, but not performing enough. So it's not all about insolvency. It's about doing stuff well enough. And I think that's a really important thing to think about.
Just
one point. On the tech side, what we find is that you look at tech businesses and think, well, when the directors raised their money 4 years ago, 5 years ago, they were told to basically grow their business. Here is 20 million, here's 5 million, 10 million. Go out and spend the money, not with too much regard to burn rate, just grow the turnover, grow the footprint, build out 3 offices, build out a future. So when they return to raise the second or the third series of money, they will come into the market and say, I've achieved everything. I've burnt my 5 million. I've got 6 employees, 10 employees, 20 employees. I've got an X sort of turnover. I'm losing money, but I've done my bit. They then hit the wall of the new VC. It says, oh, I want some EBITDA. I actually may even want some net profit. I actually want to see a burn rate of not the level you've got. I want to see that money lasting 2 years rather than 6 months. And so what we find sometimes is that directors and investors are shocked at when they raised the money 5 years ago, 4 years ago to today. And therefore, when they get into the wrong zone, they think they've done absolutely everything. So they have to pivot. And I think, again, special situations allows people to pivot, because we have to say, if you go to the market doing what you think you should be doing, it's not right. Therefore, we need a new concept. We need to pivot. We need to make some redundancies or some cost reductions. And you've still got the chance of having a good business, but you've got to be thoughtful about it. You can't just carry on the way you've been carrying on for the last 2 or 3 years.
Yes. Question really on your on fees and structure and how you can help people, because by definition, if they're talking to you, there's a problem with cash flow, etc. Generally, how do you help people? Is it on the back end that you get a fee, or like how does it work?
So when I was working years, I haven't taken an appointment for an administration since 2007. Whilst I'm an insolvency practitioner, I haven't used my license in anger. So in those days, I'd be charging on a time cost basis.
Yeah.
And therefore, whether I succeed or fail, it goes into administration or it succeeds, I'll be after X £1,000 based on Y hours.
Yeah.
Working in special situations, we try and become aligned with success. So we say to the directors, or we say to the shareholders or the P house, we need a small base level of money, which basically is like a corporate finance fee, a retainer. But then we want to say, we want some milestones. So if we achieve A, B, or C, such as no failure, or renegotiation of your creditors, or reduction of your creditors, or we've actually raised X million pounds, we want to take a slice of that money. So therefore we align with success, because often we go and see people who say, I've only got 50 grand, 100 grand in the bank. How can I afford your fees to do certain things? And so, well, we'll take a view. If we deliver, we get paid from the success of delivery. And I think that's a very important thing, because we're backing ourselves. We're saying we think we're so good that we wouldn't take on your case if we thought we was going to lose money. Therefore, we'll risk our upside with your upside. Again, empathy, really, really big point.
Yeah. Now, I'd love to know what your current view of the market is at the moment. People come up to me and say, oh, restructuring, you must be very busy. And they often come up to me, when actually there's not very much going on in the restructuring market. And people's perception of what's actually going on in the economy and what's actually going on is very different. But I do get the sense that we're in a bit of an uptick for very obvious reasons, whether it's Trump and tariffs and somewhat undermining some of the business confidence, or the Reeves new national insurance increases. That there is a sort of sense that things are a little bit difficult. Are you finding a bit of an uptick in your opportunity set?
I think the issue is it's a bit like retailers. They always blame the weather. Insolvency practitioners are always looking for things to say, oh, it would be better if A, B, and C happened. I think what you'll probably see is that most of the restructuring organizations have built or build bigger businesses and build more fees every year, consistency. Whereas, never mind whether they think there's an economy boom or bust. So looking at the tariffs that have just come out, because it's the 1st of April, the tariff issues that are going to come out in the next couple of days, everyone's going to go, oh my God, those are terrible. But I think directors just have to do what they have to do to get by. Restructuring people, turnaround people will always look at businesses that they can make a lot of money saving businesses who have problems. So whether a business is affected by the tariffs, for example, or is a retailer affected by all the increase in the employment costs, I think there's always going to be winners and losers. And so therefore, I look at some of the retailers out there, and whether you think they have a big problem because of the extra employment cost, some of them would still have a real problem, give or take the employment issue, full stop, because perhaps structurally they don't work today, whether 10 years ago they were great. Perhaps they've lost their customer base. Perhaps they've lost their ability to be relevant. So, for example, lots of people saying in retail there's issues over the business rates. The business rate has been around for like 20 years. Everyone complains about it all the time, saying, how can we pay these expensive business rates if we are bricks and mortar versus the online retailers? It's been the same for a number of years. But there's still businesses with bricks and mortar that win, and there's still online businesses without bricks and mortar that lose. So I think sometimes it's not to do with tax, it's not to do with Trump, it's not to do with the Labour government. It's often to do with the management, how they view the world of reality, and how they, as special people, can say, I can see an angle on this business and turn it around because of the uniqueness of the management. In the hands of a also-ran management, it would fail. So I'm a great believer in backing the brains of management.
Yes. Yeah, no, fair enough. In terms of restructuring people in particular, sort of often sort of saying, oh, I my business would be a lot better if X, Y, and Z. But I'm sure it's like if you go and hustle and you find stuff to do, and it's the same with the management. So it's like, if they're really good, they can make a profit, and frankly, if they're not very good, they're probably going to fail. So I just wanted to move on. We're coming to near the end, but I'd love to know your view on the future of special sits. And in particular, do you think it will be sort of just more of the same? I'd love to know how technology might, impact the future.
So with technology, I think when you look at a traditional firm, you have partners at the top of the apex, and at the bottom you have graduates, and then associates, seniors, assistant managers. So I think there's a lot of work that's done at the bottom end, which can be replicated by technology. So technology will make our lives more efficient. It'll make it more, and therefore allow team members to be even better than they are. So for example, AI, already, I was in a meeting yesterday about AI, and it's eye-opening as a person of my age, thinking, oh my God, I could get that done easily by AI. I look at the markets and look at these people on TikTok, and they're talking about how they run their global world from their desk using AI. And you're thinking, that's a one-man band, and that person is sending out stuff, understanding stuff, etc. So I look at our team, 1,800 people in it, thinking, what could we do if we fully embraced AI and had some really strong thought process and say, how could AI create extra time, more efficiency, or extra brilliance? So, for example, when we look at, sometimes we look at a company and we put in the data into an AI type of model, what does it show things that perhaps we haven't seen? Perhaps it does, but what it doesn't do is necessarily write the interpretation of what it's seen. So I see AI really helping us get to the grunt work, the basic works. But then you see two numbers. What do those two numbers mean? And how can you link them together? To me, that's where the natural brain, history, etc. of me or my colleagues will work. But at the bottom level of work, I see AI and technology really helping us and actually just being quicker and more efficient.
Yes.
You asked about special situations. Does it have a future? I think it has a huge future, because I think insolvency is a bit of a turn-off. People don't want to go and say, oh, I know, I'd like to go and see an insolvency practitioner and talk about the insolvency of my company. That's not necessarily going to happen. I think there's euphemisms for it, but ultimately, I think more people want to say to themselves, how do I improve my business? Is it a turnaround? It's not remember what I said, special situations isn't about failure. It could be just about enhancing success. So therefore, if we can enhance success and say, can special situations help people from tax? So for example, last week I went into a project, and I had a tax advisor, myself, a debt advisor, and ultimately we were looking at how and where to actually improve the business. And one of the I was speaking at I co-hosted an entrepreneurs event, because again, Smith and Williamson is quite all about mid-market entrepreneurship. And I spoke to a tax advisor, one of my guys, and he blew me away on something about a brownfield site tax you can get. Now, I didn't know this. And so I've got a case where ultimately it's a very, very large case. It's a brownfield site, it's got planning issues, but it's got some dirty ground in it. And therefore, what do you do with it? And he was talking about how tax can allow you to actually claim millions back. I didn't know that. So as a pure insolvency practitioner, I'd never know it. As a special situations guy, I'm looking at all manner of people to create a holistic attitude. So when I talk to people about their problems, it's from a tax point of view, it's a debt finance point of view, it's a transaction point of view. Which I think is why special situations will outlast perhaps some of my colleagues in pure insolvency, because people are attracted to, how can I improve? It's not about failure, it's how can I improve?
Yes. I mean, I think it is very intellectually demanding and difficult to see AI completely replacing an Andrew Pepper at the moment. No. I mean, that's not going to happen, but I at least anytime soon. But I do see your point about having AI being able to sort of be your, co-pilot, your help, informational information to get to you a lot quicker. And I think on that note, I feel like we've covered a huge amount. Is there anything I haven't asked you that you wished I had?
Oh, that's tricky.
And I'm thinking a little bit, because you just wrote an article about government involvement, and I thought that might be something that you want to bring out.
Yeah. So ultimately, having done this style of work for a number of years, in the past, there's been a number of government interactions. So government I define as quangos, government departments. So planning, HMRC, looking at things like local government, looking at the taxation, looking at issues to do with regional development grant aid stuff. In the past, I think the touch points that government extended were few and far between. What's happened in the last year and a half, I think, is much more heavy. So therefore, even though as a turnaround practitioner, I could say to a client, I think we can do A, B, and C. And then I'm up against maybe planning officials being hopefully more open. In the past, they were closed, but it still takes time. I think looking at the UK government has invested a lot of money into UKGI, which is basically the restructuring team for the government. I think that's a very big positive, because they've now brought in experts to sit alongside the civil service to help the government understand what the reality is of the world. Years ago, I was the last bidder for Woolworths, and I was taken in to see the Department of Industry to talk about the Woolworths issue. And there was a very naive exchange from the government officials to me and my colleagues talking about well, can we delay the administration of Woolworths by another couple of months because it's just prior to Christmas? And there was no real understanding about the fact it was costing millions of pounds and who was paying for it. This wouldn't happen these days. The UK GI are very specialised, very smart people, often taking people from industry. And therefore, I think sometimes it's very important to say the government has great touch points, but also it can have touch points which are counterproductive. And the trick is for an insolvency restructuring professional is how can we work with the government to make sure those points are not going to kill the business. So, for example, a good example is everyone's talking about HMRC being tougher. And I think it has been tougher, but then I've also experienced them giving long delays, ability to pay back, time to pay, adjournments of winding up petitions. So therefore, in those positions, they're being very, very good. So sometimes I think the things are, it's inconsistent. That's where I think my biggest conclusion on that article was if you knew exactly what was going to happen, you as an advisor could say to the client, this will happen if you do A, B, and C. Where there's inconsistency, that causes a problem for the client and it causes a problem for the restructuring advisor because you just don't know, thinking we try our best, this usually works. And therefore, I think that's unfortunate.
Well, look, Andrew, I think our time's drawing to an end. I think you've been a great ambassador for Special Situations and for
thank you.
The new brand. And I wish you good luck in the new iteration. And I'm sure you actually don't need it. You sound like you're busy and you're going to be helping a lot of people in the future. So thanks for coming on the show.
It's very enjoyable, and that's why I do it.
Great. Thanks, Andrew.
Thank you.
You've been tuning in to the Turnaround podcast with your host, Stephen Phillips. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, freilibertas.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.